The federal government just made investing in property in your super easier. And if you've got money sitting in your super, not giving you the kinds of return you really want, you might want to hear this. Because for a little while now, many property investors have been terrified to touch their super. There was this one massive tax problem hanging over everyone's heads that made investing in property feel almost a little like financial suicide. But something just changed. I've been investing in property now for 23 years, and over the last 9 years, I've helped over 500 other investors create wealth through property. And what the government just announced? Well, it could unlock hundreds of thousands of dollars in wealth for everyday Australians who maybe can't afford to buy a property in their own names. But on the flip side, if you miss this, you might be kicking yourself in, say, 10 years' time when so many others have used this opportunity to build wealth in their super, and you've missed out. So today, I'm going to show you what this change really means and how you can use it to your advantage. So how exactly did the federal government just make investing in property in your super easier? Well, many property investors for a little while now have been quite terrified of putting property into their self-managed super funds. And the biggest fear was the so-called proposed unrealized capital gains tax. Now, here's how that was going to work. You buy a property, it rises in value, and after a certain threshold, you would need to pay tax even if you hadn't actually sold the property yet. It was literally forcing people to pay tax for money they hadn't actually seen in their bank account. Highway robbery in my mind. I mean, did some government advisor say that property investors could maybe just sell a couple of bricks off their investment properties to pay the tax so they wouldn't have to sell their whole property? I mean, talk about dumb, right? But thankfully, common sense prevailed at the last minute. The federal government has now officially scrapped the unrealized capital gains tax. That means if your property inside your SMSF goes up in value, you won't be taxed on that growth until you actually sell. So you only pay tax when or if you actually sell the property and realize the gain. Now, this brings property in line with how it should have been treated all along. So if you were put off by the unrealized gains tax, that roadblock is now gone. So don't let outdated fears hold you back from what could be perhaps one of the smartest moves you make for your retirement. Because when the government was talking about this unrealized gains tax, the media was talking about it everywhere because it was bad news and they really wanted to promote it. But the moment it was scrapped, it barely got a mention. So make sure you're not making an investment decision for your super based on some outdated media headlines. Now, just before we move on, if you are thinking about investing in property, I've put together a free guide that walks you through exactly what to check before you dive in. You can grab that for free using the link in the description below. Now, there's another change that makes this even better for the long term. Now, don't get me wrong, the federal government is still coming after people who use their super to create wealth. They are still going to get anyone who has a balance of $3 million or more in super to pay more in tax. But previously, they were not going to index this figure. This means that while $3 million might seem like a lot today for our kids, $3 million in a few years, it's not going to go that far. And a lot of young people were going to be caught up in this scheme paying an excessive amount of tax when they started to plan for retirement. Thankfully, somebody gave the government a lesson in basic economics and taught them about the power of inflation and how it erodes money, because now the government has decided to index the $3 million super balance threshold so fewer people are going to be impacted over time. This means everyday investors now are not going to be caught up in policies meant for the ultra wealthy. It's actually going to be a somewhat fairer system and keeps SMSF property investing accessible for more Australians. Okay, so now we've covered what's changed and why these changes can protect you long term. Now, let's say you have maybe $250,000 to invest in your self-managed super fund or SMSF. With the unrealized capital gains tax now gone, where should you put it? Property or shares? Most people assume that if you have, say, $250,000 to invest, it doesn't really matter whether you put into property or shares inside your SMSF. Now, I'm not a financial advisor, This is not financial advice. What I'm sharing here is based on my now 23 years of investing experience only. So let's say you had $250,000 in cash in your SMSF. Option one, you can buy shares. You invest $250,000 into the share market, and then your returns are based entirely on that $250,000. That's it. That's your ceiling. You have a second option. You could buy a property. Now, with $250,000 as a deposit, your SMSF could borrow to buy a property for, say, $800,000. Of course, it depends on your borrowing capacity. But let's say you can buy a property for $800,000, if not more. But now what's happening? Well, you're getting growth not on the $250,000 that you've got in your SMSF to start off with. You're actually getting growth on $800,000. Now, let's say a property grows at 6% per year, okay? Not massive, but just for this example, 6% growth on $800,000 is $48,000. Meanwhile, if that same $250,000, you go and put that into the share market and it also grows at 6%, what does that give you? It gives you about $15,000 or so. So that means just looking at growth, the capital growth on the property would be over 3 times the capital growth on the shares in terms of your return on capital, okay? Now, of course, there's a few other things to consider. Liquidity, you need to get yourself some financial advice. But if we just look at the gross gains here that you can get, hopefully you can see that because of the power of leverage, the gains can be much higher when you invest in property. Also, property, especially in Australia, is far less volatile. It doesn't go up and down depending on maybe what the US president decides to do when he wakes up in the morning. Okay, so there are a number of reasons why people do prefer investing in property, especially if you want sort of leverage returns with lower volatility. And remember, with the unrealized capital gains tax now gone, you're not going to be taxed on that annual growth from the property until you actually sell it. So the gains, they just keep compounding tax-free inside your super. So if you've got significant cash sitting in your SMSF and you're wondering how do you amplify or increase your returns, property with leverage could be the answer. Just make sure you're working with a qualified SMSF specialist and a mortgage broker who understands the rules around borrowing in an SMSF. Now, I know what some of you might be thinking. You might be thinking, this all sounds great, Nero, but I can't even afford to buy an investment property in my own name. How is this relevant to me? Well, that's exactly why you need to pay attention to this next part, because buying a property in your SMSF could be your best shot at getting another investment property, even if you can't afford it personally. You see, many people seem to think that SMSFs are only for the wealthy, for people who already have multiple properties and are just looking for more tax advantages. But for everyday Australians who maybe can't afford to buy an investment property in their personal name, their SMSF might actually be their best and sometimes only shot at getting an investment property. Think about your situation right now. Maybe you're still paying off your home mortgage. Maybe you've used up your borrowing capacity. Maybe you've got a great income, but the banks just won't lend you for whatever reason. Or maybe property prices are just too high for you to be able to afford another property in your personal names. But if you've been diligently contributing to your super for years, especially if you're maybe in your 40s or 50s, and maybe you have $200,000, $300,000, $400,000 or more sitting in your SMSF and you're not happy with the returns, that's actually a deposit on a real investment property that can grow in value, where you can actually pay it off over time, and it can actually set you up for retirement. And with the unrealized gains tax now removed and thresholds for wealthy super balances indexed, the government has actually made it easier to use your super to invest in property. So this isn't a win for just wealthy investors. It's a win for anyone who feels maybe locked out of the property market, but has still been building their super balance. So if you can't afford to buy a property in your personal name, check your super balance today. You may have more than enough to make this work. And if you want help figuring out whether you have enough in your super to make this work and what your next steps should be, you can book a free call with me using the link in the description below. We'll run you through the numbers together, and I'll let you know if investing in property, does it actually make sense for you or not? So now you know why this government change has made investing in property in your super much easier, and why I believe it's one of the biggest opportunities we've seen in years. But knowing the rules, that's just one piece of the puzzle. If you really want to grow your wealth through property in 2025, you need to know where to buy, what to avoid, and how to structure your investments in the smart way. And that's exactly what I'm going to cover in this next video. The ultimate guide to property investing in 2025. We'll break down the top strategies, markets, and numbers you need to know before making your next move. I'll see you there.